Continuing with our conceptual framework discussion, today we are going to be looking at the capital maintenance concept discussed in the framework. Now, here, what is the issue? The issue is, how does the entity define the concept of capital maintenance that it seeks to maintain? First of all, do you need to maintain capital? Well, it is good business practice to do so, and in terms of most developed countries with good legislation behind their Companies Act, companies should only pay dividends out of profits in order to maintain a company's capital. And why do you want to do this? In order to protect the providers of capital, i.e. shareholders and debtors. Now, two concepts of capital maintenance pop up. Firstly, your financial capital maintenance. Now, financial capital maintenance, here you've got to look at your financial statements, and here I'm asking you whether your net asset value, or assets minus liabilities, is greater than or equal to the balance at the beginning of the year. Okay, so end of the year, greater or equal to net asset value than beginning of the year balance. The second concept is that of physical capital maintenance. And physical capital maintenance isn't really encapsulated by many of the accounting standards, but it's a good concept to understand. Now, physical capital maintenance refers to productive capacity or operational output. Now, here I'm talking about, can you manufacture or sell or give as much production at the end of the year as compared to the beginning of the year? So, what is the rest of this lecture about? First of all, how do we define profit? And should we take into account the effect of changing prices? Best thing here is to have a look at a little example. So let's start off. Company A commences business on the 1st of January 2010 with 100,001 share capital. Company A purchases 20,000 units of inventory at R5 each on the 1st of January, and that has a total cost of 100,000. Company A then sold all its inventory during the year for a total of 120,000 in cash. Let's quickly journalize those transactions. The first transaction is the receipt of the investment by investors. So debit bank and credit share capital. Now that is 100,001. So that's our first little journal. And just down the right hand side, I'm going to keep a record of the equity balance. Here a positive will be the credit, and we've credited equity share capital with 100,001. Next up, 100,000 of that share capital was used to purchase inventory. Now please, inventory is a statement of financial position accounts. The balance sheet has not affected profit and loss, has not affected equity yet. So that has had no effect on equity. The third transaction was during the course of the year, all the inventory was sold. So we had a cash receipt during the year of 120, and we had a credit to revenue, sales. Now that revenue is a profit or loss account. Went through the statement of profit and loss and other comprehensive income, 120,000. So that increases equity by 120. But related to that, now we have to recognize the cost of sales expense, which also went through profit and loss. The credit there is removing the inventory from our records as we have sold it. So we made the statement of financial position account smaller by 100, and we debited the expense of cost of sales with 100,000. Now that 100,000 makes equity smaller. So just to take note, for the year, we made a 20,000 profit. The overall effect on equity now, at the end of the year, I have 100,001 plus 120 minus 100,000. So that gives me 120,001. That's my total equity. And let's now go and look and see what happens. So a 20,000 Rand profit was earned, and we could hypothetically pay out a dividend of 20,000. And that dividend would be debit. Let's call it shareholders for dividends, or dividends declared. That dividend declared, remember, is a equity account. It's not an expense. It's a direct transaction with shareholders. And the credit would be the actual payment from bank. Let's assume it was paid cash straight away. So we take out the 20,000, and I'm left with 100,001 in equity at the end of the year. Now, in terms of financial capital maintenance, yes, the 100,000 is exactly the same, or the 101,000 is exactly the same as it was at the beginning of the year. So, in terms of financial capital maintenance, it was capital neutral. It stayed the same. So the equity chest remained unchanged. Let's now have a look at the concept of physical capital maintenance. So continuing with our example, let's assume that the company wishes to purchase another 20,000 units on the 1st of January, the second year, 2011. What happens? Prices go up. That's how the world works. In most countries, there's inflation, and now inventory will cost 5 Rand 40. So therefore, with the same capital of 100,000, the company can only purchase 18,518 units. Understand here, in 2010, we could purchase 20,000 units. Okay, for that 100,000 Rand. But in 2011, I can only purchase 18,518 units. Assuming that the full 20,000 from the first year was paid out. Okay, what has happened here? Financial capital maintenance was the same, but the physical capital maintenance has decreased. So, because we distributed the full 20,000 in dividends in 2010, the ability to purchase goods has been eroded. So a lot of people would then ask, and this has been asked in different forms of what accounting practice should be. Academics ask this a lot. Should that initial profit of 20,000 then not be recorded as 120 minus the 108, which was made up of the 20,000 units times 5.4, namely 12,000. So just take note, this is not the actual accounting standards talking here. That's the thought process. Okay, should we take into account inflation or not? Here we're saying, well, possibly, if we wanted to maintain physical capital. But IS2, for instance, dealing with inventory, sticks to the measuring of inventory at lower of cost or net realizable value, does not take into account inflation. Other assets are, however, measured at fair value, current cost, replacement value, in order to try and take into account the effects of increasing prices. So let's just go back to the framework now. The framework refers to two different concepts of capital maintenance: the financial capital maintenance and physical capital maintenance. In our example, financial capital maintenance, example, in 2010, we bought inventory for 100,000. We sold it for 120, made profit of 20,000. Our net asset value was increased by 20,000. Therefore, we could pay out that dividends of 20,000 and not decrease the capital to below 100,001 Rand. But the physical capital maintenance, however, needed to take into account the actual productive capacity. So could we buy the same amount of inventory in the 2011 year, the second year, as we did in the first year with the same Rand value of 100,001 Rand? Well, here, no, went from 20,000 units down to 18,000 and something units, okay, due to the effects of inflation. So in our example, financial capital maintenance was maintained, but physical capital maintenance was not maintained after the 20,000 dividends was paid out. So quickly, in terms of the framework, financial capital maintenance is defined as follows. Profit is only earned if financial or monetary amount of net assets at the end of the period exceeds the financial net assets at the beginning of the period. That is very different to our physical capital maintenance. Here, profit is only earned if the physical productive capacity of the entity at the end of the period exceeds the physical productive capacity at the beginning of the year. Now, most of the accounting standards are very focused on financial capital maintenance, well, because we can actually define that. Physical capital maintenance, there's no real accounting standards to deal with that because we can't define that in black and white as easily. So, thank you for your time. Please, this is not an important concept for academic purposes, but it does help you understand some of the contents or concepts behind why we do what we do in accounting. And the important concept here is understand we need to maintain capital, okay, in order to protect investors and suppliers of capital. If we don't do that, the whole corporate system doesn't work, and that is the reason why much of this type of theory is incorporated into many of the companies acts around the world. Thank you.